NXP Semiconductors NV, stock ticker NXPI, is a Dutch semiconductor company that supplies high-performance mixed-signal chips. Founded in 2006 as an independent company, but with roots dating back to the late 1800s, NXP is now a $52 billion by market cap technology giant that employs more than 34,000 people. The company operates under 4 end markets: automotive, 52% of fiscal year 2022 revenue; industrial and IoT, 21%; communication infrastructure and other, 15%; and mobile, 12%. NXP has positioned itself well in all of the most exciting and fastest growing areas of technology. Morningstar has this to say about NXP's main business line, and I quote, "The merger of Freescale and the former NXP in 2015 led to a powerhouse in automotive semiconductors, which makes up about 55% of the company's total revenue. Like many of its chip-making peers, NXP is well positioned to benefit from safer, greener, smarter cars in the years ahead. It is among the market leaders in automotive semis, especially in microcontroller units or MCUs, which serve as the brains of a variety of electronic functions in a car." Unquote. It's important to point out that NXP's automotive business line is not only its largest, but also its fastest growing. That's because vehicles are quickly becoming electric and smart. It's an exponential curve in technology. In addition, NXP's strengths in MCUs carries over into IoT, which is allowing the business to generate strong growth there. And NXP remains a key supplier of components such as power amplifiers for wireless infrastructure equipment. What we have here is a diversified semiconductor company that's exposed to some of the most durable sources of demand in all of tech. And that's what should make its revenue, profit, and dividend growth durable over the long run. Already, the company has increased its dividend for 6 consecutive years. The 3-year dividend growth rate of 40.2% shows what a strong start NXP is off to, although much of that growth was fueled by an expansion of the payout ratio off of a low base. That said, the most recent dividend raise was 20%, so the dividend growth remains brisk. You get to pair that double-digit dividend growth with a market-beating yield of 2.1%. This yield, by the way, is 90 basis points higher than its own 5-year average. That's an incredible spread, but the speed of the dividend's rise makes it hard to create an accurate comparison here. Still, the payout ratio is only 38.2%, so I'd expect NXP to continue increasing its dividend at an aggressive pace. NXP has the makings of a high-quality compounder. For long-term dividend growth investors who have time to let those big dividend raises add up and compound, NXP offers some fascinating dividend metrics. Looking at business growth, NXP increased its revenue from $4.8 billion in fiscal year 2013 to $13.2 billion in fiscal year 2022. That's a compound annual growth rate of 11.9%. Great top-line growth here. I usually look for a mid-single-digit top-line growth rate from a mature business. NXP might not necessarily be mature, but this is still excellent growth for a large business. Meanwhile, earnings per share grew from $1.36 to $10.55 over this period, which is a compound annual growth rate of 25.6%. Remarkable bottom line growth. However, I'd be careful with drawing too many conclusions here. Fiscal year 2013 was unusually weak, and fiscal year 2022 was unusually strong. Connecting these 2 points creates what is probably the most charitable view of NXP's long-term growth profile. Other shorter periods over the last decade are not nearly as dazzling, indicating that NXP is likely growing at somewhere between a high single-digit and low double-digit mark. Looking forward, CFRA is forecasting an 8% compound annual growth rate for NXP's earnings per share over the next 3 years. I get it. This is a long way off of what NXP put together over the last decade, and so it does look pessimistic against that backdrop. However, again, the preceding 10-year period was special and unique in many ways. I actually agree with where CFRA landed here, and I see it as a pretty realistic take on what NXP will likely put together over the next few years. This passage from CFRA highlights the larger picture for NXP, and I quote, "We are optimistic about content increases in the automotive space, with over 1/3 of NXPI's exposure to that end market concentrated on high growth areas for advanced driver assistance systems, EVs, infotainment, and secure in-vehicle networking. Despite recent softness across non-auto, e.g. mobile industrial, as customers reduced inventories, revenue remains resilient. We note China concerns, but see NXPI as less exposed to potential US-China political turmoil. Europe-based, we positively view greater cash to return to shareholders. Given NXPI's improved free cash flow potential, we project about $3 billion annual run rate, unquote. I think that sums it up pretty well. The major growth driver for NXP will be rising chip content per vehicle. There are a number of trends that are causing vehicles to become more technologically advanced, including the expansion of infotainment systems, electrification, and self-driving capabilities. All of that bodes well for the likes of NXP. Some issues here and there, but NXP is running a great business that's growing at a very good clip. If we take CFRA's projection as our near-term base case, that sets up the dividend for like or better growth. The low payout ratio offers flexibility here. A dividend growing at 8% plus annually, building on top of a 2% plus starting yield, sets shareholders up for a 10% plus annualized total return, assuming a static valuation. I see nothing wrong with that at all. Moving over to the balance sheet, NXP has a good but not excellent financial position. The long-term debt-to-equity ratio is 1.5, while the interest coverage ratio is nearly 9. I'd like to see the leverage situation improve, but I don't see anything immediately troublesome here. Profitability is robust. Net margin average 13.8% over the last 5 years, while return on equity average 18.2%. Overall, NXP is running a great business. Other than the balance sheet blemish, there's almost nothing to dislike, and the company does benefit from durable competitive advantages that include economies of scale, R&D, IP, technological expertise, switching costs, and barriers to entry. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. The very business model is a risk unto itself, as NXP must continuously innovate and stay ahead of the tech curve in order to remain competitive. NXP is not very diversified by end market. NXP is heavily reliant on the auto industry, an industry which is vulnerable to cyclical downturns. Any changes to chip content per vehicle or the ways in which autos are manufactured generally could have a major impact on the business. Being a multinational business, NXP is exposed to currency exchange rates and geopolitical risks. I see the balance sheet as a key risk, as NXP is more leveraged than a lot of other technology companies. There are definitely some risks to keep in mind, but the quality and growth profile of the business should also be kept in mind. In addition, after a recent 12% pullback in the stock's price, we appear to have an attractive valuation present. The stock is trading hands for a PE ratio of 18.8. That's a below market earnings multiple on a great business. It's impossible to compare this to NXP's own recent historical average, as lumpy GAAP earnings have created nonsensical PE ratios. However, we can see a current sales multiple of 3.9 that compares nicely to its own 5-year average of 4.2, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. That dividend growth rate is as high as I'll go, but I think NXP deserves the benefit of the doubt. It's well below the company's demonstrated dividend growth to date, and it's right in line with the near-term forecast for EPS growth. Plus, with the payout ratio being as low as it is, NXP could easily grow the dividend at a rate that slightly exceeds the rate of EPS growth, at least for a number of years. If anything, NXP may well grow its dividend at a rate that is higher than what I'm anticipating, but it's hard to imagine the business falling well short of that expectation. That said, I'd rather err on the side of caution. The dividend discount model analysis gives me a fair value of $219.24. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates NXPI as a 4-star stock with a fair value estimate of $240. CFRA rates NXPI as a 5-star strong buy with a 12-month target price of $250. I came out a bit low here. Averaging the three numbers out gives us a final valuation of $236.41, which would indicate the stock is possibly 16% undervalued. Here's the bottom line, guys. NXP Semiconductors, NV, is a great business that has hitched its wagon to some of the fastest growing and and most exciting end markets out there, with a market-beating yield, a double-digit dividend growth rate, a low payout ratio, more than 5 consecutive years of dividend increases, and the potential that shares are 16% undervalued. Long-term dividend growth investors looking for a high-quality compounder at a reasonable valuation should have their eyes on this name. And now for a special news announcement. McDonald's Corp, stock ticker MCD, just did it again by raising its dividend by 9.9%. That's the 48th consecutive year in a row in which the company has increased its dividend. This world-class fast food chain looks very interesting after this dividend raise, which comes on the back of a recent 10% slide in the stock's pricing. A 10% slide in the stock and a 10% raise in the dividend have combined to bring the yield up to 2.6%, 40 basis points higher than its own 5-year average. Who isn't loving it? Non-shareholders, I guess. Take a look at McDonald's here. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.